Welcome to Griffonomics. So by the year 2030, the United States is going to be short a staggering $275 billion worth of senior housing.
Yeah, that is just a massive number. I mean, it's not just some abstract demographic shift we're talking about here.
Right? It's a tidal wave.
Yeah.
It is a literal tidal wave of demand crashing into a brick wall of physical supply.
Exactly. You're staring down this entire generation of baby boomers crossing a threshold where, their need for assisted living or memory care.
Or skilled nursing.
Right, skilled nursing. It transitions from this distant possibility into an immediate, non-negotiable necessity.
Which is why today we're looking at the two healthcare real estate titans who are basically treating this crisis as, well, the greatest wealth creation event of the decade.
Oh, absolutely. The scale of this demographic inflection point cannot be overstated. We are looking at a fundamental reshaping of the healthcare and real estate landscapes, and it's hitting right now in early 2026.
Yeah, you have this scenario where guaranteed needs-based demand is colliding with an environment where building new physical supply is just incredibly expensive and slow.
So slow,
Yeah.
which creates a fascinating juxtaposition.
It really does. So to navigate this 2026 inflection, we have pulled a really formidable stack of source material for you.
A heavy stack.
Yeah, we've got Q4 2025 and Q1 2026 earnings transcripts. We've got the 10K and 10Q SEC filings, proxy statements detailing executive compensation, and some really extensive analyst narratives.
Which is great because we're evaluating two heavyweights taking completely opposing strategic approaches to the exact same macroeconomic problem.
Right. On one side, we have the Ensign Group, trading under the ticker ENSG. They are the premier skilled nursing operator in the country.
And then on the other side, we have American Healthcare REIT, ticker AHR. They represent this high-growth, asset-heavy, diversified real estate investment trust.
So our mission today, for you, the listener, is to generate a highly granular strategic comparison and build an investment roadmap.
Yeah, we are contrasting the total return potential of these two giants. And to do that properly, I mean, we really have to look past the surface-level revenue numbers that catch the headlines.
Right, the flashy stuff.
Exactly. We are specifically going to address how they handle inflation hedging, the underlying structure of their leverage, who actually holds the pricing power in their respective micromarkets, and the deep operational moats they've constructed to protect their margins from competitors.
Okay, let's unpack this. Because before we can even talk about the financial returns, we have to understand that these two companies represent fundamentally different business model archetypes.
Yeah, this is the classic structural battle of the operator versus the owner.
Right. So let's start with the owner. Looking at the filings for American Healthcare REIT, AHR basically operates as an asset-heavy landlord.
Meaning they own the physical buildings, like the brick, the mortar, the roof over the seniors' heads.
But they are entirely separate from the day-to-day healthcare operations inside those buildings, right?
Exactly. They boast this highly diversified portfolio that's segmented into four distinct categories. The first is their integrated senior health campuses, or ISHC.
Cool. And those are purpose-built campuses averaging about, 12.6 years old?
Yeah, roughly 12.6 years. And they're designed specifically for aging in place.
Which is a brilliant model, honestly.
It is highly strategic. So a resident moves in for independent living, and then as their acuity needs increase over the years, they transition to assisted living, then maybe memory care, and eventually skilled nursing.
All without ever leaving that specific campus.
Exactly. From a real estate perspective, this dramatically reduces resident turnover and, the marketing costs associated with constantly refilling empty beds.
All right, continuity of care becomes the ultimate retention tool.
Precisely. Now, their second segment is the senior housing operating properties, known as SHOP.
Okay, and those cater to different segments of the elderly population based on personal needs, mostly relying on private pay residents, right,
Yeah.
rather than government reimbursement.
Correct. Then we have outpatient medical, or OM. These are multi-tenant properties leased to hospitals and physician practices under long-term leases.
And those have fixed annual rent escalations, typically ranging from 2 to 3% per year, if I remember the filings right.
You do. And finally, they're triple net leased properties, which include senior housing and skilled nursing facilities where the tenant, the operator, pays literally all property-related expenses.
So AHR's broad diversification across these four segments basically creates a classic income and value play.
Yeah, their value proposition to the market is heavily weighted toward a reliable annualized dividend yield of $1 per share.
A full dollar. And that dividend is insulated by the varied risk profiles of their portfolio.
Right, because the steady, predictable rent checks from the outpatient medical segment provide a floor, while the explosive growth in their SHIP segment provides the upside ceiling.
And that SHIP growth was wild. They delivered a remarkable 25.2% same-store net operating income growth for the full year 2025.
It's massive. They are basically constructing a portfolio built for stabilized, dividend-yielding safety.
Okay, now contrast that passive capital allocation model with the Ensign Group. Ensign is not a diversified landlord collecting rent checks. They are an operator.
Oh, very much so. And looking at their 10K, their strategy is incredibly aggressive.
Yeah, they use this high-growth cluster turnaround model. Like, while AHR might use its capital to buy a beautiful, newly built, stabilized senior housing facility that's already 70% occupied,
Ensign goes hunting for the distressed, underperforming skilled nursing facilities.
we're talking about broken facilities sitting at 30% occupancy with terrible one-star or two-star clinical ratings from the government.
It's wild. Ensign acquires them, drops in their own elite management teams, and initiates a total clinical and financial turnaround over a 12 to 18-month period.
Which perfectly establishes the divergent total return narratives here. If AHR is the income play, Ensign is a pure momentum compounder.
Exactly. Ensign is taking the substantial cash flow generated by its mature facilities and just relentlessly reinvesting it into acquiring more of these distressed operations.
Yeah, and following an exceptionally strong first quarter in 2026, Ensign's management raised their annual earnings per share guidance to a range of $7.48 to $7.62.
That's huge. The midpoint of that guidance represents a 15% earnings increase over 2025.
Right. They are manufacturing their own organic growth through operational friction.
They really are.
I want to ground this in a practical analogy for you listening. Comparing these two models feels like looking at two different real estate investment philosophies entirely.
Oh, for sure.
Like AHR is essentially operating like a wealthy landlord who buys luxury apartment buildings and hires a top-tier property manager, or even like a massive index fund tracking the broader demographic upside of the senior housing market.
Right. They buy premium assets, diversify, and hire third-party experts to handle the messy reality of the underlying businesses.
Exactly. Ensign, conversely, is operating like an aggressive house flipper or a specialized private equity turnaround firm. They find the absolute worst house on the block, a fundamentally broken factory with terrible unit economics, acquire it for pennies on the dollar, completely overhaul the management, and turn it into a mansion or, a cash printing machine.
That's a great way to look at it.
But looking at the sheer friction involved in Ensign's model, does Ensign's house flipping model inherently limit its scale compared to AHR's capital allocation model?
Whoa.
I mean, a REIT can deploy $1 billion to buy a dozen stabilized properties in a single afternoon. Ensign has to go in and physically fix the plumbing, fire the bad staff, and rebuild the clinical reputation of every single building they buy.
What's fascinating here is that the friction you just described is exactly what creates Ensign's defensive moat.
Oh, interesting. How so?
Well, both of these models are valid, but they attract completely different types of investors depending on their appetite for direct operational friction versus passive real estate holding. Turning around a clinically broken, skilled nursing facility requires immense human capital.
Right, it's not just moving money around on a spreadsheet.
Exactly. It requires recruiting nurses, administrators, and compliance officers and physically integrating them into a broken culture. Because that lift is so heavy, the barriers to entry for competitors are practically insurmountable.
Ah, I see. A random private equity firm cannot just wake up tomorrow and replicate Ensign's clinical turnaround engine.
Nope. Now, AHR's model is infinitely more scalable on paper because deploying capital is exponentially faster than training a specialized nursing staff.
But there's a catch.
Huge catch. AHR relies entirely on the operators they hire. If an operator mismanages a facility, AHR is left holding a highly specialized, expensive, empty building that isn't generating rent.
Right, so acquiring the physical real estate is merely the price of admission. Owning the building is totally irrelevant if you cannot figure out how to price your services and squeeze a profit out of it in an inflationary environment, which is really where the war is won.
Absolutely. We've spent the last few years watching inflation fundamentally disrupt operating margins across literally every sector.
Yeah. So how these two companies structure their pricing power to hedge against inflation is where the true strategic war is being fought.
And the baseline for this pricing war is the supply and demand imbalance we touched on earlier.
The $275 billion senior housing shortfall projected by 2030.
Exactly. That shortfall guarantees the demand side of the equation. In foundational economic terms, when demand is guaranteed and physical supply is heavily restricted, whoever controls the existing supply possesses extraordinary pricing power.
But the mechanisms AHR and Ensign employ to capture that pricing power are structurally distinct, aren't they?
Very. Let's examine AHR first.
Okay. If I'm looking at their portfolio, I see a mix of traditional leases and something called our RIDEA structure. For those listening who might not be deep in the weeds of commercial real estate law, why is RIDEA so critical to AHR's ability to fight inflation?
It's a great question, because historically, REITs were just passive landlords collecting fixed rent checks.
Which is a terrible place to be when inflation spikes.
Right. Before the REIT Investment Diversification and Empowerment Act, which is what RIDEA stands for, a healthcare REIT was legally prohibited from participating in the operational profits of the healthcare facilities they owned.
Wow, so they could only collect a fixed lease payment.
Yeah. If the operator running the facility suddenly saw profits double, the REIT saw literally none of that upside.
Ouch. So RIDEA changed the regulatory landscape.
Completely. Under this structure, AHR can lease the property to a wholly owned taxable REIT subsidiary, which then hires an independent third-party contractor to manage the daily operations.
So mechanically, AHR gets to capture a direct percentage of the operational upside.
Exactly. They aren't just cashing a flat rent check. Their revenue fluctuates with the success of the building.
And looking at their SHOP and Integrated Senior Health Campuses segments, substantially all of the resident leases are short-term, meaning 1 year or less.
Yes.
This seems like a massive advantage in an inflationary environment. Like if labor costs surge or the price of medical supplies jumps, AHR doesn't have to wait 5 years for a commercial lease to expire to recoup those costs.
No, they can dynamically push street rates aggressively as soon as a resident's annual lease is up for renewal.
That is the precise mechanism. In their Q4 2025 earnings call, AHR management explicitly noted they're pushing street rates higher than inflation.
But, and this is the big but, there is a structural drag on AHR's overall inflation hedge.
Okay, what is it?
While their senior housing segments are protected by this dynamic pricing via short-term resident leases, their outpatient medical properties and triple net lease properties are tied to long-term commercial leases.
All right. And those long-term leases typically feature fixed annual rent escalations of only 2 to 3%.
Exactly. If inflation is running at 4 or 5%, the real value of the cash flows from those specific segments degrades over time.
That creates a really bifurcated portfolio. Half of AHR's assets can dynamically adapt to the macro environment, while the other half is locked into rigid historical pricing models.
Precisely. Now, transitioning to Ensign. Ensign isn't a traditional landlord utilizing RIDEA or triple net leases. Their inflation hedge comes from a completely different direction.
Yeah, I was reading through the structure of their internal real estate holding company, Standard Bearer, and the numbers are just staggering.
They are. Ensign is fundamentally an operator, but they also own a significant portion of their own real estate.
Right. Out of the 179 real estate assets they own through Standard Bearer, 155 of them are completely debt-free.
Debt-free. That debt-free real estate portfolio provides what is arguably a superior, unconstrained inflation hedge.
How so? I mean, break that down for us.
Well, think about the vulnerabilities of a traditional healthcare operator. If you operate a facility but rent the building from a REIT under a triple net lease, you have a fixed, non-negotiable expense hanging over your head every single month.
Right. Rent is due no matter what.
Exactly. If inflation drives up your nursing labor costs, your margins get squeezed from the bottom, while your fixed lease payment squeezes you from the top.
But Ensign does not have that vulnerability on those 155 properties.
Because they don't have to pay rent to a third-party landlord on their debt-free properties, they absorb labor and supply cost increases without the rigid lease constraints burdening AHR's triple net segments. Their operational flexibility is unparalleled.
Wait, let me push back on AHR's dynamic pricing strategy for a moment. We've established they use RIDEA and short-term leases to push street rates higher than inflation. But AHR relies heavily on its SHOP segment, which consists of private pay residents.
Yes, mostly seniors paying out of pocket.
Right, these are seniors paying entirely out of pocket every single month. Dynamic pricing sounds flawless in a corporate boardroom, but out in the real world, isn't there a ceiling to how much they can raise prices before seniors simply run out of money?
That represents the ultimate theoretical vulnerability of any private pay model. You're continually testing the elasticity of consumer wealth.
Eventually, the well runs dry.
You'd think so. However, AHR's management specifically addressed this dynamic ceiling during their Q4 earnings call. The reason they can push street rates so aggressively right now, and the reason the consumer is absorbing those hikes, is directly tied to their occupancy levels.
Ah,
AHR's properties are currently cresting over 90% occupancy, 90.6% to be exact.
wow.
When your building is almost entirely full and the surrounding geographic market is suffering from that projected $275 billion shortfall of new units we mentioned, you possess supreme leverage.
The demand for quality senior housing is just so inelastic that the pricing ceiling simply has not been breached yet. Here's where it gets really interesting. Because pivoting from abstract pricing theories to the raw financial realities and exact inflection points of late 2025 and early 2026 detailed in the source material, it's wild. We need to look at the actual scoreboards.
The financial scoreboards present a stark contrast in growth methodologies. Let's examine Ensign's Q1 2026 performance first.
Okay.
They reported an 18.4% revenue surge, achieving $1.4 billion for the quarter.
But that revenue growth was not purely organic, right?
No, it was heavily driven by an aggressive acquisition spree. They integrated 22 new operations into their portfolio in a single 3-month period.
Acquiring 22 struggling facilities in one quarter is a breakneck operational pace. I mean, every single one of those buildings requires a new administrator, a clinical audit, and a massive cultural overhaul.
It's an insane amount of work. Now, AHR's financial reality tells a completely different story. They did not grow by acquiring 22 struggling facilities. They grew through sheer organic efficiency.
All right. For the full year of 2025, AHR achieved 25.2% same-store NOI growth in its SI Shop segment. In Q4 alone, it hit 24.6%.
And the mechanical driver behind this organic surge is the concept of operating leverage.
Let's break down exactly how that operating leverage functions mechanically for an AHR facility. For a listener who might be used to looking at standard net income, how does this specific real estate metric work?
To understand AHR's operating leverage, you have to visualize the fixed cost structure of running a senior housing facility. You have a baseline of expenses that exist regardless of how many seniors actually live in the building.
Like paying the core administrative staff, running the commercial kitchen, heating and cooling the whole building.
Exactly, maintaining the grounds. These fixed costs represent a really high barrier to profitability. Typically, a facility must reach 70 to 80% occupancy just to break even and cover those baseline expenses.
So the first 70 residents in a 100-bed facility are essentially just paying to keep the lights on and the chef employed.
Precisely. But AHR is currently sitting at a highly stabilized 90.6% occupancy. Because those fixed costs are already fully absorbed by the first 70 or 80 residents, the unit economics change dramatically for the remaining beds.
Ah, I see.
Almost all the revenue generated by the 81st, 85th, or 90th resident falls straight to the bottom line as pure profit. The source data indicates that AHR captures between 40% and 70% flow through to net operating income on every incremental resident they move in at these elevated occupancy levels.
It's similar to the economics of a commercial airline flight. AHR's flow-through is like an airplane. Once the fixed flight costs, the jet fuel, the pilot's salary, the airport gate fees are fully covered by the economy seats, every single first-class ticket sold right before takeoff is near pure margin.
That's a perfect analogy. AHR is currently operating a fleet of airplanes where the first-class cabins are almost entirely full.
And the margins are consequently enormous. Now, compare that high occupancy operating leverage with Ensign's growth strategy.
Yeah, Ensign experiences the exact opposite financial dynamic during their initial acquisition phase. When Ensign acquires a distressed one-star facility, it might be operating at a dismal 30% occupancy.
Woof. At that level, the facility is actively bleeding cash.
Heavy cash. Initially, Ensign's consolidated margins experience significant compression. They absorb a financial hit because they are pouring upfront capital into fixing the physical plant, hiring premium nursing staff to replace expensive agency labor, and, repairing the regulatory deficiencies.
So they are entirely absorbing the cost of the turnaround phase. It is a period of intentional, strategic unprofitability.
Yes. However, they unlock tremendous compounded value as they execute the turnaround and stabilize those facilities. The historical data demonstrates that Ensign takes these broken facilities and, over an average stabilization period of 45 quarters, drives them up to an 84.3% occupancy rate.
Wow. So they are systematically manufacturing their own operating leverage over a multi-year horizon, building equity value from the ground up, rather than simply paying a premium to acquire an already stabilized building.
Exactly.
But let me push you on the mathematics of this acquisition pace. We established that distressed assets require substantial upfront capital to rehabilitate. With Ensign buying 22 struggling facilities in one quarter and intentionally taking a margin hit on all of them simultaneously, how do they fund this without fundamentally blowing up their balance sheet?
That's the million-dollar question. The sustainability of their model is rooted in exceptional capital efficiency and a fiercely conservative debt structure.
Okay, what kind of numbers are we talking about?
Ensign operates at a highly conservative 1.73 times lease-adjusted net debt to EBITDA ratio.
Oh, wow. That is low.
It is because their large portfolio of mature, stabilized facilities generates immense free cash flow, and because their debt burden is so minimal, they essentially self-fund this aggressive growth pipeline.
So they don't need to tap expensive commercial debt markets or issue dilutive equity to fund their growth, unlike traditional REITs.
Exactly. Though, to be objective, AHR also warrants recognition regarding balance sheet management. The sources detail that AHR recently executed a highly successful deleveraging campaign.
Oh, right. They brought their net debt to EBITDA ratio down to a very healthy 3.4 times by the end of 2025.
Yeah, which firmly supports their investment-grade trajectory.
Okay, so we are tossing around massive operational statistics here. Billions in revenue, hundreds of facilities, tens of thousands of elderly residents requiring complex daily medical care.
It's a massive logistical operation.
Exactly. And this brings up a logistical hurdle that is rarely discussed in the financial filings. I wonder aloud how these two giants actually manage the day-to-day operations and staffing of these massive healthcare empires. You cannot manage the nuanced, daily operations of hundreds of skilled nursing facilities from a centralized corporate boardroom in another state.
You absolutely cannot manage it from a centralized tower. And this transitions us directly into the role of operational innovation and structural design.
Tell me about Ensign first.
Ensign addresses this logistical hurdle through extreme radical decentralization. In fact, Ensign operates without a traditional corporate headquarters in the conventional sense.
Wait, a multi-billion-dollar publicly traded healthcare company without a corporate headquarters? How does the administrative infrastructure even function?
They utilize what they designate as a service center. This service center functions strictly as a back-office support hub. It handles payroll processing, complex IT infrastructure, legal compliance, and risk management.
Oh, so by centralizing the bureaucracy, it completely liberates the facility operators from administrative burdens.
Exactly. But the true engine of their success is the local cluster model. Ensign approaches healthcare as an intrinsically local, neighborhood-level business. They place highly autonomous, CEO-caliber leaders inside every single facility.
And these individual facilities are then organized into localized geographic clusters. So if a facility in Texas experiences a sudden spike in nursing turnover or, heaven forbid, an outbreak of an infectious disease, they aren't waiting for a regional vice president in California to draft a memo telling them how to respond.
Not at all. The local leaders within a cluster share real-time clinical best practices, financial benchmarking data, and even physical resources locally. If one facility is short-staffed for a weekend, a sister facility in the same cluster can dynamically shift personnel to cover the gap.
Which allows them to adapt instantaneously to the specific labor dynamics and clinical needs of their micromarket. Now, how does AHR navigate the operational burden, considering they are an asset-heavy landlord and do not directly employ the nursing staff?
AHR navigates this by relying heavily on elite regional operating partners. A prime example highlighted in the sources is Trilogy Management Services, which oversees a significant portion of AHR's integrated senior health campuses and SHRP segments.
Okay.
While Ensign relies on localized human autonomy, Trilogy utilizes a sophisticated proprietary AI platform to create a massive strategic advantage.
AI deployment in senior housing. That's wild. How is the AI actually functioning on a daily basis? Is it predicting healthcare outcomes or managing supply chains?
In this context, the AI is entirely focused on dynamic revenue management. Trilogy's AI platform continuously ingests real-time micro-market data. It analyzes local competitor pricing, historical occupancy trends, demographic shifts, and even hyper-local economic indicators to dynamically price every single unit in a facility.
So it's constantly adjusting the price tag on the room.
Exactly. And crucially, this algorithm doesn't just sit on a server in a corporate office. The AI pushes this pricing data directly to the local building managers on the ground.
Oh, I see. When a prospective resident's family walks through the door for a tour, the local manager has the exact mathematically optimal price, to quote them in real time, giving them a massive strategic advantage in revenue management over mom-and-pop operators.
Exactly.
So AHR is playing Moneyball with AI algorithms to perfectly price a room, while Ensign is acting like a special forces unit, dropping elite commanders into local neighborhoods.
That's a very accurate way to frame it.
But this contrast presents a critical variable. Is Ensign's absolute reliance on human leadership talent a structural bottleneck for their growth compared to AHR's scalable AI software?
It is definitively a bottleneck, but Ensign's leadership explicitly considers it a feature, not a bug.
Really?
Yeah, Ensign operates on a rigid philosophy they call the first who concept. Ensign will systematically refuse to acquire a new, distressed facility, no matter how cheap the real estate is, until they possess a fully trained, culturally vetted administrator ready and waiting in the wings.
From their CEO and training bench, right?
Exactly. They maintain a perpetual bench of these leaders. This strict human capital requirement intrinsically limits their velocity of expansion, but it drastically mitigates the execution risk of their fast-paced acquisition.
Right. They do not purchase the physical real estate until they possess the human capital necessary to execute the turnaround.
Right. And to be fair, AHR's Partnell trilogy isn't exclusively reliant on cold algorithmic pricing either.
Oh, what else are they doing?
The source narratives highlight a fascinating component of Trilogy's labor strategy. They focus intensely on employee engagement. They have a formalized program that literally shows a minimum wage dietary aide or janitor the exact educational and career pathway to become a registered nurse.
Oh, wow. That's incredible. And does it work?
The result is profound. Their employee turnover rate is consistently below 40%. For context, in the long-term care industry, the average annual turnover rate fluctuates between 80 and 100%.
Maintaining turnover at less than half the industry average is a monumental financial advantage, particularly when navigating severe nursing labor inflation.
Retaining institutional knowledge and avoiding the exorbitant costs of recruiting and training replacement staff constitutes a profound competitive moat for Trilogy and, by extension, AHR.
But, you can have all the sophisticated AI algorithms and elite local cluster commanders in the world, and it ultimately doesn't matter if the executives at the very top of the corporate hierarchy aren't incentivized properly.
Oh, absolutely.
This requires us to examine corporate governance and the specific metrics dictating how the executives of ENSG and AHR are compensated. Show me the incentive structure, and I will show you the operational outcome.
It's the golden rule of business.
If I'm an investor looking at AHR, I want to know exactly what behavior I am paying the management team to execute. So how is AHR structuring their executive compensation?
AHR's compensation philosophy is intensely focused on pay-for-performance metrics tied directly to the fundamental health of the underlying real estate. The objective corporate performance metrics that dictate executive cash bonuses are strictly tied to two figures: normalized FFO per share, which carries a 60% weighting, and same-store NOI growth, which carries a 40% weighting.
We mentioned FFO earlier, but let's clarify that for the listener real quick. Why use funds from operations instead of standard net income? In traditional equities, net income is the gold standard.
In commercial real estate, standard net income is heavily distorted by depreciation. The IRS requires you to depreciate the value of a physical building over time, which counts as a massive expense on the income statement.
But in reality, well-maintained real estate generally appreciates in value.
Exactly. FFO adds that non-cash depreciation expense back into the equation, providing a much more accurate representation of the actual cash the REIT is generating. By tying 60% of bonuses to normalized FFO, AHR's executives are explicitly paid to protect and expand the reliable cash flows that fund their dividend.
And what about the regional operators like Trilogy?
They utilize a 3-year long-term incentive plan, or LTIP. It is paid entirely in AHR stock, and the payout is strictly correlated to bottom-line EBITDA growth.
I was reading through the mechanics of that LTIP, and it seems remarkably elegant. But, and this raises an important question, in the healthcare operations space, the easiest way to hit a top-line revenue target is to simply fill every empty bed, regardless of the cost.
Oh, absolutely.
How does AHR prevent a regional operator from destroying profit margins just to hit an occupancy bonus? Like, an operator could theoretically hire incredibly expensive temporary agency nurses at double the standard hourly rate just to ensure they have the staffing ratios required to fill every empty bed.
That is the exact hazard of misaligned incentives. Top-line revenue surges, but the bottom-line profit is entirely consumed by the exorbitant labor costs. But AHR's LTIP specifically neutralizes this risk.
Because the stock-based bonus is strictly tied to bottom line EBITDA.
Exactly. It financially penalizes operators for utilizing margin-crushing agency labor. If a regional manager blows their budget on temp nurses, they systematically destroy the value of their own highly lucrative stock bonus.
It flawlessly aligns the financial interests of the independent operator with the financial interests of AHR shareholders.
It's a brilliant structure.
Now let's examine the Special Forces commanders over at Ensign.
Hmm.
How do you compensate an executive team tasked with buying fundamentally broken businesses?
Well, Ensign's executive cash bonuses are primarily driven by adjusted EBT, or earnings before taxes. But the true genius of Ensign's governance structure, the element that truly differentiates them, is that a significant portion of their bonus pool is tied directly to clinical quality metrics.
I want to make sure I understand this correctly. Their financial bonuses are explicitly tied to medical outcomes.
Exactly. The compensation committee evaluates executive success based on CMS 5-star ratings, reduced hospital readmission rates, and rigorous compliance audits.
Wow. And the Centers for Medicare and Medicaid Services, or CMS, assigns that rating from 1 to 5 stars based on health inspections, staffing ratios, and quality of resident care.
Right. By forcefully tying executive compensation to achieving 4- and 5-star clinical ratings, Ensign guarantees that the operational turnaround of a distressed asset is actually legitimate and sustainable.
You cannot simply apply a fresh coat of paint to a failing nursing home, slash the budget, and extract cash.
No, you actually have to heal the patients, improve the staffing ratios, and pass rigorous state inspections. That high-quality clinical reputation is what generates referrals from local hospitals, which organically fuels their EPS momentum over the long term.
We have just painted a very compelling picture of perfectly aligned incentives, AI algorithms, and clinical turnarounds. But if we hit a mild recession in late 2026, which of these compensation models is going to hold up better when the going gets tough? I'm not solely looking at the upside projections, I'm looking at where the floor falls out.
Evaluating downside protection requires analyzing the distinct vulnerabilities of each portfolio. Both have defensive traits, but Ensign's model might survive a recession better.
Because their bonuses are tied to needs-based clinical care.
Exactly. Their rationale is tied to the nature of the services they provide. If an individual suffers a severe stroke and requires complex post-acute physical therapy or requires a ventilator, they cannot defer that medical care simply because the broader economy has entered a recession.
It is a non-discretionary necessity.
Right. Furthermore, 69% of Ensign's service revenue is derived from government payers, specifically Medicare and Medicaid. AHR, conversely, relies heavily on its SHOP segment, which is a private pay model.
Which introduces significant consumer exposure for AHR.
Yes, AHR's FFO relies heavily on private pay seniors having the cash to afford their dynamic pricing.
Right. If a severe recession materializes, or more specifically, if the residential housing market experiences a depression, seniors may find themselves unable to sell their primary residences. And since the proceeds from those home sales frequently fund AHR's entrance fees and dynamic pricing models, a stagnant housing market directly threatens AHR's occupancy flow-through.
Exactly. This perfectly frames the broader market skepticism surrounding both equities. Neither of these models is invincible.
So let's delve deeply into the specific structural risks. Let's start with Ensign's weak spots.
The most prominent risk factor for Ensign is the dual-edged sword of that 69% reliance on government payers. While it insulates them from consumer recessions, it massively exposes them to stroke-of-the-pen regulatory risk.
They're at the absolute mercy of federal and state budgets.
Completely. If the federal government decides to slash Medicare reimbursement rates by 3% to balance a budget, or if cash-strapped state legislatures reduce their Medicaid allocations, Ensign absorbs an immediate direct contraction to their top-line revenue.
And they cannot simply offset that by raising prices on the consumer. The government giveth, and the government taketh away.
Exactly.
Beyond the stroke-of-the-pen reimbursement risk, what about the sheer operational friction? The execution risk seems terrifying.
It is staggering. Ensign's entire growth trajectory is predicated on constantly digesting broken, dysfunctional 1- and 2-star facilities. They are inheriting buildings with toxic cultures, inadequate financial reporting systems, and severe regulatory deficiencies.
Their model hinges entirely on their capacity to recruit, train, and retain enough local leaders to manage an acquisition pace of 20 or more facilities per quarter.
Right. If that highly specialized talent pipeline fractures, their compounding momentum hits a brick wall.
Let's stress test AHR now. They largely bypass the government reimbursement risk by focusing on private pay seniors in their SHIP portfolio. We discussed their exposure to the housing market, but what constitutes their primary operational vulnerability, considering they delegate the actual management of the buildings?
AHR's primary vulnerability is classified as asset allocation risk. They spend years vetting regional operators and constructing financial models before purchasing real estate for those partners to manage.
But ultimately, AHR is surrendering direct control.
Yes, if an operator goes rogue, misallocates resources, suffers a catastrophic drop in clinical quality, or faces financial insolvency, AHR is left holding the bag. They own a massive physical, highly illiquid asset that is suddenly underperforming.
Evicting a failing healthcare operator is not like evicting a residential tenant.
Oh, not at all. Transitioning a massive building filled with fragile, high-acuity seniors to a new management team is a legal and logistical nightmare.
So what does this all mean? Ensign is tied to the whims of the government printing press, while AHR is tied to the whims of the local housing market. Pick your poison.
It really comes down to that.
I mean, I have to ask the listener directly. Would you rather bet on Medicare reimbursements staying steady or the U.S. housing market staying strong? But regarding Ensign's execution risk, the historical data suggests they have practically weaponized their turnaround process, correct?
The data strongly supports their execution capabilities. Despite systematically acquiring broken one-star facilities that initially dragged down their corporate averages, the Q1 2026 data reveals a remarkable stabilization curve.
Right.
85% of Ensign's mature operations ultimately achieve 4- or 5-star quality measures from CMS. They are currently outperforming the national average for quality measures by 18.2%.
So they do not merely warehouse distressed real estate. They successfully rehabilitate the clinical operations. So we have systematically deconstructed their business archetypes, their inflation hedging mechanics, the application of AI and decentralization, the alignment of executive incentives, and the structural vulnerabilities of both models. Understanding these risks allow us to finally answer the core objective of the episode: who is best positioned for the rest of 2026?
Let's move to the final verdict. To establish this, we must contextualize these companies within the current macroeconomic environment. We are operating in a definitive, higher-for-longer interest rate paradigm.
Right. The cost of capital remains significantly elevated compared to historical norms. And how does that elevated cost of capital alter the competitive playing field?
It precipitates a severe contraction for smaller, over-leveraged regional operators who fundamentally relied on cheap, zero-interest rate debt to sustain their operations. In this specific environment, we classify Ensign as the offensive aggressor.
Because of their dry powder.
Yes. They are currently positioned with a $600 million completely untapped credit facility alongside $539.5 million in cash equivalents. That represents over $1 billion in immediately deployable dry powder.
Wow. When you synthesize that liquidity with their exceptionally conservative 1.73 times leverage ratio, Ensign possesses the unique capability to actively hunt and acquire distressed competitors at steep discounts.
They can execute acquisitions aggressively while traditional real estate buyers are forced to remain on the sidelines due to prohibitive borrowing costs.
And AHR's positioning in this high-rate environment.
AHR is positioned as the organic beneficiary. They are not executing a massive debt-fueled acquisition spree. Their strategy is highly disciplined. They have successfully match-funded their recent acquisitions, fixed 100% of their debt to insulate themselves from rate fluctuations, and are coasting on a secure investment-grade trajectory fueled by organic NOI flow-through.
They are strategically allowing the demographic pressure of the silver tsunami to fill their existing beds, passively capturing that outsized 40–70% net operating income flow-through as their portfolio occupancy crests past 90%.
Exactly.
So AHR built a fortress that can weather the storm, but Ensign built a warship that's actually sailing out into the storm to conquer new territory.
I love that analogy. If we connect this to the bigger picture, both of these organizations are highly probable to thrive over the next decade. The fundamental demographic wave of the silver tsunami is simply too massive to fail them.
Right.
However, they represent distinctly different vehicles for capital allocation. ENSG provides a mechanism for aggressive, compounded operational momentum. AHR provides a mechanism for stabilized, dividend-yielding real estate safety.
It is a phenomenal masterclass in deploying two radically different structural approaches to exploit the exact same macroeconomic catalyst. But before we conclude, leave the listener with one final provocative thought to consider.
All right, here's the ultimate variable to mull over. We have dedicated significant analysis to how Ensign acquires and rehabilitates distressed properties from the pandemic era. But what happens when that massive pool of distressed, heavily discounted assets finally dries up?
Oh, that's a great point.
If Ensign exhausts the supply of broken one-star facilities to acquire, will their 15% EPS growth hit a brick wall? Or will their captive REIT, standard bearer, systematically evolve and begin aggressively deploying capital into entirely different healthcare asset classes to sustain the momentum?
That is the multi-billion-dollar question that will define the back half of the decade for this sector. Well, thank you for joining us on this deep dive into the 2026 inflection. Whether you are prepping for a high-level strategy meeting, stress testing your own portfolio allocations, or simply insanely curious about how institutional capital is navigating the most significant demographic shift in modern history, you are now armed with a comprehensive shortcut to being deeply well-informed on healthcare real estate dynamics. Risk defined, portfolio protected.